Money Effect, where I aim to bring you all the news topics surrounding money and investment. And I guess the best place to start this week and the biggest news is right on the headlines that in America, the US of A, the consumer prices jumped from to 6.2% in October, and that's the biggest inflation surge in more than 30 years. Now, if you've been listening to my channel, you know inflation is a mainstay topic. It affects basically everything. It's going to affect your investments in terms of your assets, and it's also going to affect your money, which we'll get onto. But in terms of the actual print, with inflation is getting higher. So last week we saw the Federal Reserve. They kept the interest rates on hold, but they did, in the UK as well. They kept their interest rates on hold. The Bank of England, but the Federal Reserve did start tapering the bond purchases, so decreasing the money supply in essence. So kind of a signal that they know that there's going to be a time where they're going to have to increase interest rates to deal with inflation, but they believe it's something that they can do gradually. And here's where the problem is going to lie. So if we look in America, this is the consumer price index. Saying we have that in England as well, but in England we also have the retail price index, and that is more representative because obviously that includes things like energy bills. Now we all know we're getting into a cold winter, but we know energy bills have gone higher. Food, if you go out and do some food shopping, you can see that food prices have gone higher. I actually went to the shops the other day and I was looking at, I've got a bit of a sweet tooth, and I was looking at, £1 wine gums. They're now £1.50. This was in Sainsbury's. So I think I've seen them at £1.35 in Tesco. So already there you see that 35p increase, in something so plain. You're going into the shops, you rarely see, I shop in Lidl's. I'm not even gonna lie. I don't even, you know, that's why stores like Lidl's are growing. If you go into the big supermarkets now, you rarely see the deals. Even Tesco's now, they don't even do deals unless you've got a club card. You have to put your club card on and get the deal. But before it was never like that. So you can see that, things are getting up, they're getting more expensive. Now, this was the biggest surge. And what's really going to be interested in is it's going to be in this perspective of, does it keep surging? If it doesn't keep surging, then it could just be a one-off. But it's going to be interesting. I think there's another print next month, of course, to just keep looking before the Federal Reserve, December the 15th, they're going to have a meeting. And obviously, the UK kind of follows what the USA does, so it is really important to keep up to date with that. Now, we've got two issues here, and if you're wondering why the Federal Reserve is so relaxed, so if we look at Janet Yellen, she's now actually the Treasury Secretary in America. Basically, that's the equivalent of the Chancellor in the UK. That's Rishi Sunak, so that's her counterpart. But she also used to be head of the Federal Reserve, so she knows it well. She should know what she's doing, and obviously she's got a statement here saying we won't allow inflation to reach the 1970s level. That's in the period where inflation was rampant and economic growth was slow and employment was high. That's the stagflation, the worst we want to get into. And obviously, she's saying we're not going to reach those levels. Why is she saying that? Why is she so confident? Well, one thing is, like I said, as she says here, actually, you know, she expects inflation to get to an acceptable level of roughly 2% by next year. Now, we've just seen that inflation is at 6.2%. So we have just seen that inflation is at 6.2%, and she's saying that we're going to get back to 2% next year. Okay, why is she saying this? We've discussed this. She's saying this because she believes that the supply issue is mainly transitionary. That inflation is going up because we've got things like, if you've been looking at AMD, for example, semiconductors industry, they've been unable to produce things. AMD does chips, so everything needs a chip these days. Your phone needs a chip, your car needs a chip, your laptop needs a chip. Everything needs chips. So as these costs are going up, they had not been able to produce them. That's passing on the costs to the goods. Obviously, as well, we've seen energy suppliers. We've seen the issue here. Um, you know, we had a large shortage bringing in petrol that increased petrol, which is interesting now because apparently this lorry shortage is over, but petrol's still going up. So this is what the Federal Reserve is saying. OPEC, they've been restricting supply to keep the price up. Hopefully next year they'll start increasing supply into the market. Petrol price will go down. The UK will hire more lorry drivers, surpass all these EU regulations, and then we're getting more supply in. So her theory is that this crisis is a supply issue, and next 1 or 2 years, we're going to start getting back supply. We're in November now. We've got vaccine rollouts. We've got treatments coming. We're not locking down again. You know, it to turn off the tap, it's instant, but to let the water running out, it takes a while. And that's basically what she's saying. The Federal Reserve is saying that next year we don't need to rush to increase interest rates now, because next year supply is going to keep going up, keep going up, keep going up. At the moment, it's inflation is still going up. So next year, if inflation is still going up and supply supposedly has increased, then we're going to have a problem, and that's when the Federal Reserve might start panicking and increasing rates to bring down inflation, and that's when we're going to have a problem. For me, in reality, I believe it's the money supply. So we've seen, we saw, because of the pandemic, we saw the Bank of England, we saw the Federal Reserve, we saw governments. They basically just pump money into the economy. Obviously, as you pump money into the economy, that in itself gives people more money. When people have more money, what do? Especially if it's free money. You saw in America, for example, we take the stimulus checks. They was handing out that free money, and what do you do when you get free money? Now, if you work for your money, yeah, okay, on a Friday or Saturday night, you might want to go out and have a few drinks. Obviously, you've had a stressful week, but more likely you're going to save. When you get free money, when you win the lottery, when you win on gambling, you spend that money. It doesn't stay in your pocket. And what's happened is that there was so much free money has been flowing into this economy from the banks increasing the money supply, from governments increasing stimulus, that has led to demand. Now, the demand is lent to is pent up demand, what I would call, because when these stimulus checks were coming in, people weren't able to go anywhere because we was in lockdown. Now restrictions are ending. People have got all this money. People that wasn't working have got all this money. Um, People that was working have got all this money, and now demand has gone up. They're buying things. They're buying things, and I'll put them. This is an article I actually read on the BBC. So it's a recruitment firm, and they wrongly claim furlough as ex-staff. So it's basically a report about a recruitment firm. I'm not going to say which one it is, I guess, but they're basically told their employees that yes, you're on furlough. So they've claimed furlough from the government, and they're saying, but you can still work. Now, what that says to me is that if they're claiming furlough, furlough is meant to be something where, because of lockdowns, obviously the company um, cannot do its business, and but instead of letting the staff go, keep them on furlough. So when business comes back, you can bring those staff back, as opposed to it causing mass unemployment. And I don't doubt that. I do believe it was the right move by the government, but the way it was done and the way it's been abused is just, this is a perfect example. This company clearly didn't even need to put people on furlough because they had enough business, but they've still used the furlough money, which is increasing the money that they're saving. So they're saving money, using the government's money to pay these employees, and then with that money they save, what are they going to do? They're going to invest that money. So now it's like a double fold. So now they've used that government's money to invest, and then they're still paying their money. So now that's just pumping more money into the economy, pumping more money, increasing demand for things, and prices are going up. And this is the things that are happening in America with the stimulus checks. I know people that lived in the UK have good jobs, but because they had dual citizenship in America, they was getting 2-3 grand stimulus checks. They didn't need the money. right now, lockdown's ended, they've got their vaccines, they're going on holiday, they're spending. And obviously, this is why inflation is in my view, this is why inflation is going up. I don't think it's as such supply chain issues. And I think next year, we're gonna if when inflation continues to go up and supply is increasing, that's when we're gonna have problems. So in terms of the money aspects, why should you be worried? Well, it's quite simple. Interest rate, we know what the interest rate is. So the interest rate as a saver, you put money into your bank, the bank uses your money, and for that purpose, they give you some an interest rate, some money on top. Right now, the real interest rate is equal to your interest rate the bank pays you minus inflation. In an ideal scenario, your interest rate the bank gives you 4%. Remember, the government's target is 2%. The bank gives you 4%. Inflation is 2%. So 4 minus 2, the real interest rate is 2%. Now, in America, it's going up to 6%. In the UK, it's at something like 4%. Now, we look at some of these savings accounts. Now, obviously, these are easy access savings where you take the money out. They're low anyway. These are a bit with withdrawal. These are a bit more, obviously, better rates because they're more fixed. But none of these are over 2%. So that means, yeah, the real interest rate you're getting from your bank leaving it in an account is negative. That means inflation is eating your money. So you're losing money by leaving your money in a bank. Now, obviously, um, the opportunity cost might be for you that it's safer in a bank, so you don't mind losing the money. But for most people, they're going to think, wow, I need to do something with this money, get into assets, get into property, so on, so on, so on. So that this is why it matters, because one fold, you're losing money keeping it into a bank. And then if we go on to the next aspect, twofold, if interest rates do rise, well, yes, you'll get better savings, but then your mortgage is going to go up. And if you've been living so far that you don't have savings and you've been enjoying these low interest rates, and now your mortgage payments suddenly shot up because the Bank of England and the Federal Reserve say, shit, inflation has got way out of control. We need to just, interest rates are at 0.1 right now. We need to get it to 1, 2%, 3%. And your now mortgage payments, you're just about making your mortgage payments, and now they're going up by £150, £200 every month. That's going to be a problem for you. Uh, so that's why it's important to look out for inflation and interest rates, and also in terms of assets. If you look at skills as a stock, is one of the stocks that came from the pandemic. A lot of hype around it. I believe it was a SPAC. These are speculative stocks that they thrive in low interest rates environments. Obviously, these are growth stocks. They're not making any money. They love low interest rates environments so they can borrow money and make money. When interest rates go up, these stocks suffer. And you can see yesterday, this stock lost 3.8%, and you're looking over a year. Obviously, there's a lot of mania here at this time, so this is not true. But you can see just from yesterday how much it lost because of interest rate, like literally this. So these are the kind of stocks that are going to get hurt. So if you've got a lot of growth stocks in your portfolio, if you believe in the long-term vision of the skills, and it's an online mobile multiplayer video game, and you believe that everybody's going to be online in the future. We know about all this metaverse. Then obviously it doesn't matter right now, because um this is something you're going to hold in your portfolio for years to come. But if this is something where you're trading, or you're just looking to do a quick flip after a year, you need to be wary of these stocks, because if interest rates go up, these stocks are going to get hurt. So where do you put your money? Inflation is surging. Where do you put your money? Now, the one place is Bitcoin. Now, you read this article here. It says Bitcoin hits its 69,000 record after inflation's hit 30-year high. Ethereum is also notched up to new highs. Now, we will discuss two things. The new age way is we have this cryptocurrency. We're in the middle of a bull period in crypto. A lot of assets have gone up. Now, you've got a lot of assets. You've got some cryptos that can use it. You've got thousands of crypto. You've got some cryptos that you can use in real world. So Ethereum, for example, if you believe in decentralized finance, if you believe in this NFTs, I'm not going to get into a whole debate about that, but these are some of the buzzwords around Ethereum. They're kind of all built on the Ethereum network using that Ethereum blockchain. They have real world users. Things like Shiba and Dogecoin now, although I did actually do a transaction on Dogecoin and I had to transfer some money out of Binance and I transferred it to Doge and then I sent it to Coinbase. It was actually quite fast and it didn't actually take that many fees. Nevertheless, we know Shiba and Dogecoin, they're meme coins, and there's nothing wrong with those coins, but you just have to know they don't actually at the moment have any real world use. It's just a case of a community. And if you're in early on those coins and then the YouTubers and the communities take them to new highs, then you're going to make money. But it's kind of gambling. Bitcoin doesn't really have any use. It's more of a symbol, but it's now been playing around this inflation theme as a store of value. And like I say, as you can see, it hit as soon as these numbers come out, it hit a record. Now, if we look at the Bitcoin chart, because it's not truly respective, because after it hit that CPI data come out, it then slumped. But a lot of people believe that slump was a flash crash in Bitcoin. And we've seen Bitcoin do flash crashes all the time. Maybe people just want to take profits. Maybe they're just trying to squeeze out those that are over leveraged, and then we start the bull cycle again. But it's definitely Bitcoin has now got that theme as an inflation store, and I believe as inflation builds up, Bitcoin is going to go up, and we could potentially see. I don't know how much we're going to see. I'm not a crypto expert, but if you're looking for somewhere to put your money, this is the kind of place that at the moment is the buzzword now. Is Bitcoin. Beyond that, traditionally was gold. Gold is not only an inflation hedge; it's as a store of value. It's also, it's risk averse. Whereas, Bitcoin is doing flash crashes. Gold it is not. But obviously, a lot of the attention of gold has been turned away to Bitcoin. Why? Because you can buy a gold ETF, which is a futures, the same as we saw the Bitcoin futures, but as opposed to Bitcoin, which doesn't have a physically backed ETF as an exchange traded fund that holds Bitcoin. There's plenty of gold ETFs that hold gold, like they physically hold gold somewhere in a safe. But as we know, holding gold, you can't. The best way to do it is to buy gold, but it's not safe. You put gold in your house, that's running the risk of getting robbed. Then if you put it in a storage facility, you've got to pay extra storage costs. So there's a lot of things around gold, and that's why a lot of people are going into Bitcoin, because basically you buy Bitcoin. Ideally, now I remember in 2017, you go on Amazon and you look for a ledger to move your Bitcoin off wallet, and literally, I don't think anyone does that now. People just leaving it on Coinbase. Coinbase is the biggest company now. It's fairly secure. If it does get stolen, I'm not sure if there's any like official way to get any compensation, but it's something that can be investigated. Or you can move it to wallets. Like PayPal's got a wallet, Coinbase have got their own wallet. So there's so many ways now to kind of store your crypto as opposed to moving it off into a ledger and forgetting the ledger details. That it's definitely people turning away from gold and thinking, I don't really want to store gold. But gold is traditionally, it's a hedge against inflation, and it's a hedge in a risk averse society. So that's definitely, if you're somebody that believes, things are getting expensive, um, I'm not getting nothing from my savings, I'm just losing money. Like if your wage ain't increasing, then you're losing money. You need to be looking at, Bitcoin and gold. Also, in terms of assets, again, banks, look, Barclays today, it's up 1%. Interest rates go higher. The banks are going to make more money, because at the moment they can't really make any money in terms of lending. Well, theoretically, because the interest rate is so low. But once the interest rates go higher, they can then pass that cost on to used and get more money for mortgages, etc., etc., etc. And hence, we looked at Lloyd's, Barclays. These stocks are up today based on the news of yesterday. So if you're worried about keep the inflation mind. This inflation story, it's going to be a topic you have to keep it in mind. Like I said, for your money and for your assets. So, and if you're thinking about where to put your money, those are some of the places that I would start researching and see if it's feasible. And if it does have truth, Bitcoin is a store of value, start researching it. But yeah, thank you for your time today. This is the Money Effect channel, and if you like what you've seen, please like and subscribe.